Hi, and welcome to this market and economic update. In today's video, we'll discuss 5 key insights that are likely to be important for investors as we head into the final quarter of 2023. The last 2 years have no doubt been challenging as markets have swung pretty dramatically in both directions. Throughout this, however, markets have hung on to strong year-to-date gains, even in the face of continued rising interest rates. At the same time, inflation continues to fall, and the Fed has signaled that they prefer to keep rates higher for longer. And certainly over the last several weeks, geopolitical risk is on the rise. In the next few minutes, we'll cover all these topics in a few important charts. First, this chart highlights the performance of stock and bond markets this year. The stock market has held on to double-digit gains, which is great news for investors after last year's bear market. But bond markets, on the other hand, have struggled as interest rates have jumped. Despite this, it's important to not lose perspective. The decline in bonds this year, while challenging, pales in comparison to last year's bond bear market. In total, being diversified across stocks and bonds has worked better for investors this year than in 2022. Next, the reason that bonds have struggled somewhat is due to rising interest rates. This chart shows how much rates have jumped not just over the past year, but since the bottom in 2020. Perhaps most important for investors is the fact that real rates have increased. Unlike nominal rates, real rates are adjusted for inflation, so they reflect the real purchasing power that investors have from bond payments. Today's real yields are the most attractive since at least 2007. Another important driver of markets this year is the fact that a recession has not yet occurred, regardless of your definition of one. If you recall, many investors and economists believed there would be a recession in 2023. Not only has this not happened, but the economy has been quite strong. On this chart, you can clearly see not just GDP growth, but the different components across time. Consumer spending has helped to keep growth steady. Business spending and government spending have both contributed at times as well. Economic growth matters right now because it drives decisions by the Federal Reserve. The Fed is trying to balance economic growth with improving inflation. While inflation has improved this year, growth that is too strong may mean that the Fed could keep rates higher for longer. This chart shows the projections made by Fed governors as to where rates may be over the coming years. You can see that they expect rates to remain higher for longer, with the first rate cut possibly not occurring until later in 2024. Through all this market uncertainty, one thing that investors can control is how much and when they begin to save. This chart shows just how important this is. As a hypothetical example, delaying a $1,000 investment by only 5 years when markets are generating an annual return of 7% results in over $3,000 in lost appreciation by the time an investor reaches retirement age. What does all this mean? If anything, this year shows that markets can rebound when it's least expected. The fact that interest rates are higher presents challenges for bond prices, but it also means that investors can generate more real income than in the past. The Fed will continue to be a source of uncertainty, but the economy is actually stronger than many expected. And in the end, investors should always focus on the factors that they can control. Thanks for watching today's video. And as always, if you have additional questions, please don't hesitate to reach out. Until next time, take care.